What's holding you back from investing? Hey there. Let's talk about something we all dream about: financial freedom. You've probably heard the term investing thrown around a lot, but does it feel like this complex, out-of-reach concept? Trust me, you're not alone. Investing isn't just for Wall Street gurus or the ultra-rich. It's for anyone ready to take charge of their financial future. Today, we're breaking down the top 10 basics of investing in an easy-to-digest, conversational way. Ready to grow your wealth step by step? Let's dive in. Let's be honest. How many times have you thought about investing but had no clue why you were doing it? This is where financial goals come into play. Imagine trying to plan a vacation without knowing the destination. Sounds chaotic, right? That's what investing without a goal feels like. Your goals could be anything: buying your first home, saving for your kids' college fund, or even retiring early. What's cool about setting goals is that it makes investing personal. Instead of feeling like you're throwing money into a black hole, you're actively working towards something meaningful. Here's a pro tip. Make your goals smart, specific, measurable, achievable, relevant, and time-bound. For example, instead of saying, "I want to save for retirement," say, "I want to save $500,000 by the time I'm 60. That way, you can track your progress and celebrate milestones along the way. Okay, let's get real. Investing is exciting, but it's not without risk. The key is understanding the relationship between risk and reward. Think of it like this: no pain, no gain. If you're playing it too safe, your returns might not even beat inflation. On the flip side, chasing sky-high returns without considering the risks? That's a recipe for sleepless nights. What's fascinating is how personal this concept is. Are you someone who can stomach market dips without panicking? Or do you prefer a steady, predictable growth curve? Your answers will shape your risk tolerance. Here's a golden nugget: diversify. By spreading your investments across different asset classes, stocks, bonds, real estate, you reduce the chances of a major loss wiping you out. Remember, it's about finding the sweet spot that aligns with your financial goals and comfort level. Ever heard the saying, "Don't put all your eggs in one basket"? That's diversification in a nutshell. Imagine owning stocks in just one company. What if that company has a bad year? Yikes. Now, imagine your investments are spread across tech, healthcare, energy, and international markets. A bad year in one sector might not even make a dent in your portfolio. Diversification doesn't just apply to industries, it also applies to geography. Global diversification means you're not solely relying on one country's economy. This strategy cushions your portfolio against market volatility and gives you peace of mind. Here's a fun challenge. Take a peek at your current investments. Are they overly focused on one sector or country? If so, it might be time to mix things up. If there's one thing every seasoned investor will tell you, it's this: start as early as you can. Why? Because of the magic of compound interest. It's like planting a tree. At first, it grows slowly, but over time, it becomes a towering oak. Let's break it down. Say you invest $1,000 at an annual return of 8%. After 1 year, you've earned $80. The next year, you're earning interest on $1,080, not just your initial $1,000. This snowball effect is what makes time your best ally in investing. Here's the kicker: you don't need to start big. Even small, consistent investments can grow into a sizable nest egg. The key is to start now. Don't wait for the perfect time, it doesn't exist. If there's one thing every seasoned investor will tell you, it's this: start as early as you can. Why? Because of the magic of compound interest. It's like planting a tree. At first, it grows slowly, but over time, it becomes a towering oak. Let's break it down. Say you invest $1,000 at an annual return of 8%. After 1 year, you've earned $80. The next year, you're earning interest on $1,080, not just your initial $1,000. This snowball effect is what makes time your best ally in investing. Even small, consistent investments can grow into a sizable nest egg. The key is to start now. Don't wait for the perfect time, it doesn't exist. Stocks, bonds, ETFs, oh my. The world of investing can feel overwhelming. But here's the good news. You don't need to know it all. Just start with the basics. Stocks are like owning a piece of a company. When the company does well, so do you. Bonds are like lending money to an organization and getting paid back with interest. Mutual funds and ETFs let you invest in a collection of stocks or bonds, giving you instant diversification. What's exciting these days are new options like cryptocurrencies and ESG funds, investments focused on environmental, social, and governance factors. The key is to explore your options, pick what aligns with your goals, and stay curious. Imagine you have an emergency but all your money is tied up in assets you can't quickly sell, like real estate. That's where liquidity comes in. It's all about how quickly and easily you can access your money. Think of your portfolio like a seesaw. On one side, you have liquid assets like savings accounts and money market funds. On the other, you have illiquid assets like property or long-term investments. Striking the right balance is crucial for both emergencies and long-term growth. Ask yourself, could you access cash if you needed it tomorrow? If the answer is no, it's time to rethink your liquidity strategy. Here's a sneaky truth about investing. Fees can quietly eat away at your returns. A seemingly small 1% management fee might not sound like much, but over 20 years, it can cost you tens of thousands of dollars. Think of fees as weeds in your financial garden. The less you have, the better your portfolio will grow. Pay close attention to expense ratios in mutual funds, trading fees, and even hidden costs like bid-ask spreads. Pro tip: many low-cost options exist, like index funds or robo-advisors, which can help you save money while still building wealth. The world of investing is always changing. New opportunities, market trends, and technologies pop up constantly. The more you know, the better decisions you'll make. Podcasts, books, YouTube channels, and financial news platforms are fantastic resources. But here's the thing: don't overwhelm yourself. Pick one or two trusted sources and commit to lifelong learning. After all, knowledge is power, especially in investing. Let's face it, money triggers emotions. When the market dips, your instinct might scream, "Sell everything." But reacting emotionally often leads to poor decisions. The best investors keep their emotions in check. They stick to their plan and remember that market ups and downs are normal. A great way to stay disciplined is by setting automatic investments, so you don't have to second-guess yourself during volatile times. Think you need thousands of dollars to invest? Think again. Thanks to fractional shares and micro-investing platforms, you can start with as little as $5. Starting small is powerful because it builds momentum. Over time, those small steps add up. Remember, the hardest part is taking that first step. Once you do, you'll wonder why you waited so long. Congratulations! You've just unlocked the secrets to mastering investing basics. Now it's time to take action. Whether it's setting a goal, diversifying your portfolio, or starting with $5, every step brings you closer to financial freedom. Investing might seem intimidating, but with these fundamentals in your toolkit, you're ready to start building the future you deserve. If you found this video informative, insightful, like, share and subscribe.